we've made it. Welcome to the last video of, Unit 3 Accounting. But before that, make sure you like, share, subscribe, tell your friends, tell someone who does accounting that, hey, here's a nice lot of videos that help with Unit 3. It means a lot to me if you do. Anyway, today we're looking at cash flow statements. We're going to look at what makes the cash flow statements. We're going to go a process to categorize well, and then we're going to make a cash flow statement. Then we're going to look at some uses and some cash flow cover, which is our main indicator. And we're just going to then go through some theory, especially splitting profit and cash, because a common misconception is profit equals cash, which we know is wrong. Or if you don't know that, you will know at the end of the video. So, just a quick recap, because we've got videos in the comments where I think I've gone through the cash flow statement, but a quick recap. A cash flow statement has operating, investing, and financing activities. We use the cash flow statement to say, this is where our cash has come from, this is where it's gone, and it's categorized in a nice, simple way. So, operating activities are activities that relate to the day-to-day activities of the business. For example, cash sales, anything related to GST and wages and so on. So those really day-to-day things. Investing activities are the activities that relate to the acquisition or sale of non-current assets of the firm, and this can only be non-current asset purchases or non-current asset sales. So if we sell or buy a non-current asset. And then financing activities. These relate to the the financial structure of the firm, and they can only be your capital contributions, your drawings, loans that you either receive, or loan principals paid. So being aware of that is quite good. So we're going to use those three to form our structure. But first, let's put an example up. So right now I have an example of a statement of receipts and payments, this time for Carl's Cats. So, statement of receipts and payments, you've got all the cash inflows, all the cash outflows. The surplus or deficit in brackets is 4,220. We add the bank balance at start, 13,500, and the bank balance at end will be 9,280. Those numbers in bold will stay the same, and I'll show you what I mean in a moment. But looking at these cash receipts, cash payments, we need to make that into a cash flow statement. And you could just pick things out and hope for the best. But let's be a little bit methodical here. We know that operating is day-to-day. We know investing is only non-current assets. And we know financing can only be related to the financial structure of the firm and can only be capital contribution, drawings, loans received, and loan principal paid. So the smart way of doing it is, let's identify the obvious first. Let's identify financing. So if we go through these cash receipts, we see that there is a capital contribution and a loan received. And we're just going to put a nice little F there. Just an F to say we know those two are financing. We then will go to the cash payments and do the same, and we'll see drawings F, and we also see a loan there again from Bank, and that's going to be an F as well. We're then going to move forward and we're going to do investing, and that's going to be denoted by an I. And this time we're going to go through the cash receipts. Anything related to non-current assets, no. Looking at cash payments, we see firstly shelving. So we put an I there, and then we go office equipment and we leave an I there as well. Suddenly, what we've got left over must be operating, because it's either financing, investing, or operating. But if we've done financing and we've done investing, the leftover is operating. That is just the little skills there. And that's a cheap little trick. So you're not stuck with going, is this operating or is it not? Instead, they ask, is it financing? Is it investing? If it's not either of those, has to be operating. And we're going to put an O on those ones there. So now we've got all our classification done. What we're going to do now is we're going to construct our cash flow statement. And this time we do operating first. So any O's we put first. And just in the interest of clarity, I haven't done cash inflows, cash outflows. I've done the outflows to be represented by a bracket. So any cash inflows or cash receipts are positives. Any cash payments will be in brackets. And we can see here the subtotal of all the cash receipts in the operating area are 88,800. Meanwhile, the cash outflows or the cash payments or the brackets totals 99,820. Deduct the inflows from the outflows, and we see we're left with $11,020 in cash outflow, or a net cash outflow for operating activities. And that's going to be in the bracket, and we bold that. And we keep that bold in mind because that is important at the end. We then move on to investing. We notice any of the I's there, and it was only shelving, it was only office equipment. Negative 10,000, negative 4,500 equals negative 14,500. That's another cash outflow. And again, it is in brackets. So we then move on to the financing activities. And these are going to be any of the F's that we did. And we see here, capital 5,000, loan Ostbank 25,000 gives us a net inflow of 30,000. Against the drawings and the loan of Australia Bank as well. So they received loan and paid some back. 6,700 and 2,000, giving us a net decrease or a net bracket of 8,700. And the net cash flow from that is 21,300. And they're all in bold. And those are the three we're going to add. So if we look below, we see the net increase or decrease in brackets in cash position for the period. Now, we add up the net cash flow from operating activities, so negative 11,020 plus negative 14,500 plus 21,300. We add those three together, we get negative 4,220, or a total outflow or a total or net decrease in cash position of 4,220, represented again by the brackets. We then add the bank balance at start, which was 13,500, and our net result will be 9,280. And if we were to look at those last three lines, compare them to the last three lines of the statement of receipts and payments, we see those numbers match up. And that's a good little check to see, does it all add up? So the only number here that would go in the balance sheet directly would be the bank balance at end, which would be, because it's a positive, $9,280. And that's in current asset. If the bank balance at end is in a bracket, obviously it's a bank overdraft or a negative. So just be aware of that as well. We then move over. We're going to see, what can we use this cash flow statement we've just done? What can we use it for? Well, the first one is we use it to assess performance. We then would also plan future cash activities, and then we can also use it to calculate indicators. So, one of the questions we will be asked in this is, how do we improve our cash position? What can we do to improve it? So, the most obvious way is minimize outflows or generate inflows. So if we're going to generate inflows, we've got to look at high sales, increase accounts receivable so we can incentivize them to pay more. You could also sell assets we don't use, or the owner could contribute capital. So those are some options right there. Minimizing outflows, you might limit drawings, access credit terms if it's for inventory, so we paid inventory here, so that could be an option. We could defer non-current asset purchases, so for example, buying new shelving may not be that good an idea. Or we could even organize a bank overdraft if things are particularly dire. So those are some options there, but you want to be looking at each type of activity to determine an action to fix it. Now, when I said indicators, I think the thing we look at is cash flow cover. This is the indicator that tells us, is our day-to-day cash flow, our operating activities, able to cover our obligations of the present? And that is our current liability. So we got net cash flow from operations divided by the average current liabilities. And this is an answer to 1. So like a ratio, ... 1. Now, you want a number that is more than 1. That means if it's 1 exactly, you're able to meet your obligations, and the more times you meet it, the healthier your cash position is. Now, one thing does come up, and it's interesting, is cash equals profit. And you normally will see theory questions that go, this person believes that because their cash went up, they're making a profit. Or this person believes, because they made a profit, they have a lot of cash in the business. And that's not true. We know that. Hopefully. So let's go through some items that can increase profit but no impact on cash. That is stuff like credit sales, discount revenue, inventory gain. Let's also go through items that can reduce profit or be an expense, but don't impact cash. That's accrued expenses, which we look at in Unit 4. Inventory write-down, inventory loss, discount expense, cost of sales. Items that can lead to a cash reduction but aren't considered an expense would be repaying of accounts payable, your cash purchase of inventory, your GST pay or GST settlements, your drawings, loan principal repayments, and any prepaid expense. Because these items make our cash go down and have no impact on profit. And items that can lead to a cash increase but aren't considered a revenue. This is cash received from accounts receivable, any GST received, GST refund, capital contribution, loan received, selling a non-current asset. You could also go the way of prepaid sales is the other one as well. But again, we looked at Unit 4. So just be aware of those 4 categories because they will come up. You will be required at times to ask, why is cash different, or the increase in net cash flow different to the profit figure? And being able to refer to items from your income statement and your cash flow statement is quite useful. So that's a good skill to practice. Overall, thank you for a great Unit 3. If you have any questions, please leave them in there. And on that note, like, share, and subscribe. And I will see you for Unit 4. See ya.